I love Manu.
Okay. We got diversity on the left. We got white males on the right.
I'm diverse.
Oh. All right. This is going to be fun. Okay, let's dive right in. What's your fund size?
Pre-seed is just a marketing term.
Yeah.
There's nothing to it. Are you starting that way?
I think Manu's talking his book, but he did a damn good job. What's the fund size of the fund you're actively investing out of right now? What's your average check size? What's the average stage that you invest at? I.e., let's describe that as what's the pre-money of the stage that you invest your first check at? And how many checks per year? Can you get all that?
Sure. Bubble ratio 8.
Bubble ratio 8.
$85 million fund, 750.
Wait, slow down. How big? $75 million fund?
$85 million.
$85 million fund, sorry.
750K average check size.
Okay.
6 to 8 pre is the typical pre-money. 2 to 3
You
million
hope it's
is the
6.
size of... Sorry?
You hope it's 6.
No, it's 6 to 8. 6 to 8 pre is the valuation range. 2 to 3 is the size of the round.
Okay. How many checks?
Seed.
How many checks per year?
15. 1-5.
And how many people making decisions on your team?
3.
So you're all doing 5 deals a year? That's it?
Yep.
Really?
Yeah.
Dave calls that Monday.
I thought you've done... I was going to guess you've done at least 5 of our deals in the last year. Either we're really good at indexing.
We've done 165 investments in the last 11 years. That's exactly 15 years. 15 deals per year.
All right. And how many projected investments for this fund?
45 over 3 years.
And you're really good, so that's not too small. I won't give you too much shit. All right. Good. Hunter?
Homebrew's second fund is $50 million.
$50 million?
Yep.
Wow, you're rolling in dough.
It's, the challenge is not raising it, it's giving it back.
Ah, yes. Good point.
Average check is about 750 to 800. I'd say valuations are, usually post below 10. And we're usually entering in the first $3 million raised. Sometimes that's first dollar in, sometimes it's last $1 million in. We're sort of agnostic about how that comes in chunks because I think every company looks a little bit different. But we've, funded pre-product and we've funded, traction in market. It all depends.
How many deals per year?
And 8 to 10 deals a year. There's 2 of us.
Okay, so almost exactly the same profile. Five.
Because independent of fund size, we still both have 24 hours in a day.
Well, you blog a lot more than Jeff does, at least these days.
I have a competitive advantage in Twitter.
Jeff's already built his position in the market.
Blogging is so passé.
I'm going to skip myself for the moment, but Shadi, what's your current fund size that you're investing out of, or at least target?
So this is our first fund, and it's going to be a sub $50 million fund. We have had a first close, so we are investing now. And we're investing on average 250 to 500K. By the time we're done, we expect that to be more so 250, 500 to about $1 million.
So right now you can fit into a round with these guys, but later you're going to have sharp elbows kicking those sons of bitches out.
You got to play nice. Isn't that part of your
Wait, she said you got to play nice.
What was the rest of the questions? How many deals are we going to do within a year? Yes. I think it'll be around the 8 to 10 mark. I mean, we want to have a pretty concentrated portfolio. We're kind of figuring it out as we go, given this is the first year that we're investing.
How many people making decisions?
There are 4 of us, 3 GPs, and then we've got another part-time partner. So again, pretty concentrated.
And any estimate for number of deals in total for the fund?
Probably 25 to 30. Is what we expect. And in terms of what we're seeing, in terms of valuations, it's kind of in that 5 to 10 million.
Okay. Are you doing, we'll come back to that for a second. And Manu?
So my first fund was $6.25 million. My second fund is $40 million.
Nice.
The difference is, though, that my investment period is actually about 5 years, and it's quite likely it may end up being 6 years. So that's a thing to note. I only do about 4 to 5 investments in a year, and I'm not required to do 4 to 5 investments in a year. Like in 2013, I think I only did 1 new investment in the whole year. And then check size wise, my sweet spot is probably around 400K. And valuations, I'll actually answer by giving you a range. Probably the lowest I've ever invested in a company is probably about 1.5 million pre.
Right.
Highest I've ever invested in a company is probably about an 8 million pre.
But sweet spot's 5, sort of? You actually prefer under 4,
Eight,
right?
large variation.
Okay.
Yeah, large
All right.
variation.
I would kind of almost say you run your own in-house incubator of sorts from the way that you're investing.
I would hate to call it an incubator.
Okay, sorry. In-house venture studio?
No, but I do say that there are several cases in which I have had to convince founders to start their company.
Okay.
So, yeah.
Okay, and for the record, I guess, we're investing out of what I hope will be a $100 million fund. Is currently an $80 million fund. We have 20 people making decisions, I think, maybe more. And our typical check size is $100K on the first round, first check. If that's in our accelerator, it's between $1 to $3 million valuations. If it's seed, it's between $3 to $10 million valuations, depending on geography. And we tend to aim for 20 decisions per year. At least that's kind of the numbers. All right, so let's jump into a few things. Accelerators, worth it or not worth it? Do you guys go to demo days? Do you invest in accelerators, companies?
Worth it for the company or worth it for us? I think there's a large number of accelerators that provide value to the founders. I think there's a small number of accelerators that generate a considerable number of venture-ready companies year after year.
Okay.
I put it as, if you're a founding team that has pedigree, as in you went to Stanford, MIT, CMU, Berkeley, something like that, and you already have access to a network, then in that case, an accelerator is probably not worth it for you. But if you're a founding team that is starting a company for the first time, doesn't have a lot of credibility behind them, then going to an incubator can actually provide the much needed credibility to help them get to the next stage.
Only for Rickies, not for anybody with real networks.
So about 10 or 15% of our companies go through accelerators, but typically we invest in them before demo day.
Yeah, we've looked at a bunch that have then gone into accelerator programs. I think you can stay so busy going to all these different demo days that it can be quite overwhelming. So I'm not the best at that.
So it sounds like the panel's generally disdainful of accelerators.
The way that I've always phrased it is,
I think Manu's in competition with us, I'm pretty sure.
If there's a company that I'm meeting for the first time on demo day, I haven't done my job.
I agree.
Yeah, I would agree
Fair
with
enough.
that. But I think that there is definitely a lot of value you can get from vertical accelerators that are doing hardware startups because it's so hard to actually
Do you think
get
that
going.
the vertically focused accelerator is more relevant for you than any of the top 3 national programs?
Typically, when I start investing in a new sector, yes. After a while, less. So I think you as a seed investor, you have to be open as to where the deal flow is coming from.
Okay.
And if they do a good job really sort of helping the companies, there's no problem with that.
Do you guys think that micro VC is a category? Do you feel like there's a well-defined business model for micro VC?
Given that there is now 250 firms in that space, I hope so.
Yeah.
And it's also pretty micro because all of the traditional guys are so huge. What do you really?
Yeah, well, I mean, I think
when we
100,
go-
150
I think Manu's
million before
correct.
would've
Like
been
Series A
normal.
moved to Series B and Seed moved to Series A, even though we still call it Seed, perhaps.
I actually disagree.
Okay, here we go.
So, no, I mean,
Why?
so when I got started,
Wait,
back
what
in
was your original
2004,
check size 5 years ago, Jeff?
25. Oh, 5 years ago,
When you were raised
That
after you raised your second, whatever you called your second. fund.
100 to 250 was Fund 2, 2007, 2010.
Okay.
So when I got started and I was an angel, I was writing those 25, 50K checks. And I wasn't always sort of investing at the very beginning when there was like a founder or co-founder and an idea. I was sometimes investing on the deal that had built a prototype and was already in the market.
Right.
And so where I agree that we see an institutionalization of the very early stage seed market, which I agree is called pre-seed, it's not new, right? Some people have invested at that stage, some people have invested, post that stage. What's true is that because the operating costs of starting a company now have bubbled, Because it costs so much money to actually hire engineers and get rent in San Francisco paid and so on and so forth. What used to be a $1 million round is now only covering a portion of that 18 months runway that we need to cover. And so the 18 to 24 months cost is $2 to $3 million. And for me, the difference between seed, which is syndicated, a bunch of 2 or 3 macro VC firms, angels, a bit of angelists, and so on and so forth, versus Series A, which is one firm doing the bulk of the round, and the dude sort of jumping on the board.
Your point is that like seed rounds have increased in size, and what you're saying is it's largely due to the living costs in the Bay Area. It used to be a seed round was $500,000 to $1 million. Now seed round is $1 million to $3 million, increased by 2 or 3x. I would argue that that's more a function of VCs wanting to invest more money, not a function of the cost of living here. Cost of living has gone up, but hasn't gone up 150 to 300%.
So let me finish. Operating costs have increased because it takes more time and potentially capital.
Because Amazon Web Services cost so much more than it did 5 years ago.
To hit the Series A hurdles. So to get your Series A, you need to show more, and therefore you need.
There are these companies that actually make money, Jeff. Do you have any of them?
I actually have a fair amount of them, yeah.
Yes.
It's also a lot easier, in my opinion, for a lot of these companies to raise money. Especially if you're raising from certain types of angels, not all angels, I don't necessarily think profit maximization is the #1 thing for specific angels. For some angels, yes, they actually care about, can I make money making this investment? How much over what time frame? That's what I care about.
I think the angel market is becoming more and more price insensitive.
Yeah, it's kind of like, you know what, I might enjoy this. This is really cool. I might meet fun people. When you've got a group with that kind of behavior, it kind of messes up trying to have any kind of fair valuation. And if you're looking at it and you're like, well, I think I can raise 2 to 3 million, and that's great. I think a lot of entrepreneurs are like, why wouldn't I? And then all of a sudden they start raising all this money, and it's like, how much have you given away already before going into the seed or the
I generally
Series A?
find the average data to be very uninteresting because none of us are looking at sort of the average set of companies, or at least we hope not to be. And so the question is, in my mind, what are the capital needs and what's the competitive environment for the types of founders who think they're a good fit for Homebrew and that we're excited about, and can we find an entry point that makes sense? And for us, the seat we're asking for at the table is writing one of the larger checks in the round, but what we're committing to is trying to help them with greater probability and velocity get to where they need to get to raise that next round.
Do you guys have target ownership percentages?
Actually, I want to make a point before your question, which is, I think one of the big things that's changed is GP expectations, right? So the questions that...
What's a good outcome, you mean?
No, like what
do you need to see?
What do you need to see, right? So when a company comes...
Input KPIs.
Input, yes. Okay. So a lot of the micro VCs they're just expecting to see more. Right, and when you expect to see more, that's kind of what I feel is kind of like creating the gap. That's why I'm calling it a Series A as opposed to that's why I'm saying seed is a new Series A. So.
And so let's jump into that a little bit. What's target ownership percentage? What's a good outcome? What's a great outcome?
So the way that we looked at it for our first fund, which is $35 million, is we want to emerge from the seed round owning a percentage that we think in a success scenario could return 1x the fund. Sometimes that's 5%. Sometimes that's more than 10%. It averages to be about 10%. Do
you care more about valuation or ownership?
Care more about ownership.
Ownership, 7 to 10%. Same math. $1 billion outcome should return the fund.
Okay, and $1 billion outcome is target outcome?
It's sort of the...
$100 million outcomes aren't so great.
The math is...
Wait. Answer that question.
What?
$100 million outcomes. Good, great, not so great?
They're good, but they won't return the fund. Yeah. And so the point is...
Great. You have a founder who you put money into at an $8 million valuation. They raise another round, 10 on 30. They get an offer to sell the company $200 million. You happy or not happy?
If they're happy, I'm happy. I will support.
Bullshit. Bullshit. You're not happy.
In the way. No.
You're like, God damn it, I want to see the $1 billion exit.
I think
Jeff, when you're thinking about it as returning the fund, you're now a Series A investor.
Well, 5
Actually,
years
you're
ago,
just somebody
returning-
who's
Five
managing
5 years ago,
somebody
returning the
else's
fund
money.
was a $15 million fund.
Right.
Now,
Right.
now it's
It's a-
returning an $85 million fund.
Everyone's running the same math. It's just a question of how large your fund is.
No, that's bullshit. We're not running the same math. We're consistent at capital per partner deploy and check size. Fuck you.
You're an interesting outlier.
We've raised a lot more money than 5 years ago. I think capital deploy per partner might be going down for us.
Oh, probably.
And actually,
But-
average entry
but
point
you-
of valuation is
the way that you
consistent
do
or
that-
lower because of the
You have the
international
interesting, but I think people who look, if somebody looks at you as just total capital raise, that's the wrong way of looking at it. Because
Totally.
you do the very
Everybody should
interesting
be
micro
asking
funds.
capital per partner per year deployed. That is the right question, not total fund size.
And matched, and that will vary also matched against different markets and geographies.
How
do
many
you think?
partners in the team? How many
Yeah.
decisions per year?
So to come back to the question,
Yeah.
we will always support whatever our founders want to do, and if they're happy with a $200 million outcome, we'll be happy for them. That will return the fund. That's all.
I think part of the answer to that question for us comes in selecting the type of companies we're investing in and trying to understand if the problem, not so much challenging the entrepreneur, do they want to build a $1 billion company, are they in it? I mean, all these people who we back are interested in building something meaningful. That has lots of different definitions. The question we're trying to ask ourselves is the problem they're trying to solve, what success looks like for them. Is that likely to lead to a $100 million exit, or is it likely to be larger? We don't ask ourselves the $1 billion question.
And want to let them run their businesses.
We don't ask
exactly the way
ourselves.
they
We
want.
don't ask ourselves the $1 billion question because we think that if you can get to a few $100 million in value, you have a problem that's
Okay,
worth that.
sorry, let
Then
me
you can
re-ask
get
this
larger.
question. You guys talk to LPs and you raise money. You build models for LPs. You guys are doing 50 investments per fund. 50 investments.
45.
50, close enough. Let's make the math simpler. What percentage of those 50 investments do you expect to return 50x, basically a fund size outcome? Probably actually has to be more than 50x
Less than
because of
10%.
dilution.
Yeah, can I actually
Less
like,
than 10% is awesome. I'm talking, is it more than 2%?
Yeah.
How many outcomes out of 50 are going to be unicorns?
3 to 4.
Okay, that's a good target. How many centaurs? How many $100 million plus outcomes, not quite $1 billion, or do you even care?
Well, because of the math, 20%.
What if you're wrong and you get 0 unicorns? How many centaurs do you need to make that fund work?
I think you're in trouble.
A lot.
I mean, the way that I think about it is, if you look at a lot of early stage investing, and I'm not talking about multi-stage. You've got $1 billion. You've got different kind of risk-adjusted ideals across all of these stages. 1, 2, 3, 4, maybe 5 of these investments will make your fund. The rest, kind of meaningless in my opinion. So you could probably look at a bunch of different early stage funds and you could literally show me maybe the best 3 investments they had, and you could probably rank them in terms of how well they did just looking at that. That kind of says a lot.
I think it's dangerous to have a sub $50 billion fund and rely upon $1 billion outcomes if you're taking a concentrated approach. So I don't need a unicorn to produce the returns that we'd like to see.
Great. I agree with that
But
approach.
I'm still on the other end of the
you're hoping
spectrum.
you do.
I think that we need a few 300 to $500 million outcomes.
Right.
If 1 or 2 of those is actually 2x that, then it starts to get interesting.
So I think what Jeff is saying is I need 3 fund size outcomes to hit target returns for my LP, and I think I'm good enough to get 3 to 5 unicorns out of 50 companies. Right, which is basically you're saying I can pick unicorns 5 to 10% of the time. CB Insights says the industry average is 1%, 1.25%.
Survivorship bias.
We'll see.
Jeff's really fucking good, I guess.
Well, it depends as to the magnitude of the wins. If ever you have a company which is worth 10 billion.
Yeah, you're in great. Are you modeling for $10 billion outcomes, Jeff?
Not modeling, but it can happen.
Okay. Do you have any idea how many unicorns you have in your current fund right now? You have Fitbit coming out next week, right?
I can't comment.
Okay, same question for you guys. How good do you think you are at picking billion-dollar outcomes? Do you model for that? Do you care?
So I absolutely do not model for it. I don't model any of this type of stuff.
Okay. What do you show your LPs?
I want to work on building interesting companies. That's what I want to do.
I think you say I was in Twilio in the seed round, right?
Yes, I was in Twilio in the seed round. I was in Lyft in the seed round.
Okay.
Right, and
That's all you have to say. I was in Twilio and Lyft.
And my
That's
to-
it. I'm
I had a-
done, baby.
I had
I
a
think
total-
that's a car and a phone emoji, and he just sends them that.
and I had a
Steal
to-
model.
Drop. Give me money.
And I had a total of 19 companies in Fund 1. And that's kind of what I'm
You
targeting
had
for Fund 2.
Lyft and Twilio out of 19 companies, so you're picking 2 out of 20. He is doing 10% unicorn.
Yep.
And out of Fund 2, I expect to invest in 4 to 5 companies over 5 years. So that's going to end up being 20 to 30 companies.
Okay.
So.
All right. If you're doing 10% unicorn, yeah, you're.
But I also want to say, I want to make, like, you asked about ownership, and my comment, especially to LPs about ownership is a red herring.
I completely fucking
All LPs love to focus on ownership.
It's an absolutely
And I think
mathematically
they're
flawed
focusing
and
on
illogical
the
argument,
wrong
and I don't
thing.
want to take money from
So-
LPs who
so-
focus on ownership because you're stupid.
Wait,
So I
wait.
don't want your fucking money.
And then
Wait,
he
Dave, you're
complains that he
hijacking
can't
my
get
point.
institutional LPs. Dave, dude, if you want institutional
I'm a math
LPs,
major. I
that
know
doesn't
what-
work for them, right? You know that.
Valuation
Wait,
more
wait,
than
wait, wait. No, you're hijacking
valuation
my
more
point.
than
Hold
ownership
on.
is what you're saying.
No, so me,
I'm gonna get
ownership
Manu into trouble with
is
his
not
LPs.
about valuation, is not about ownership. I have only
gotta be
one.
about one of the
no,
two.
it's only one currency that matters to me. I'm a solo GP. The only thing that matters to me is how much time I'm spending on a company.
Manu,
And
you have
if I'm-
told me,
if I'm
that-
gonna be
you have told me
spending time on the
specifically you don't invest in deals at above $4 million valuations in the past. You may have changed your story.
I just said my range was 1.5
I know, I was
to 8.
surprised to hear that. You didn't like the fact that we had
And
companies valued at 5 or 6.
I
You
will,
thought that was too
I
expensive.
will get into a deal based on how I evaluate that deal on a case-by-case basis. I have no rules around that.
But what's your typical sort of ownership?
In most cases, I end up in double digits.
Yeah, so that's the point.
Yeah.
So you always try to get over 10% ownership.
Okay, so you're
you
still
go
ownership
up and-
over valuation.
Yes.
Yes, yes.
All right,
Yeah.
I'm the,
I
okay,
agree.
Shadi,
I'm also ownership,
ownership
over
over
valuation.
Hunter, ownership over valuation.
Valuation
It's the
ends
same
up being
thing.
binary, but in the sense that there's some places I won't go, but within a range, yes, I'm going to
How
prioritize
about,
ownership.
do you tell your LPs you have a target valuation and that that's important? And do they ask you what valuation do you pay, or they don't care?
We
No.
give them parameters
L-
and we tell them that we don't go above 20 posts.
Yeah, for us,
LPs
we back
care
into
about,
that.
care about you picking companies that get good returns. That's what they care about. If they're hung up on, like, you should be doing this valuation or that valuation, then they're trying to do our job for
Okay.
us.
I
Which
disagree.
some of them actually
Can I
want to
disagree?
understand more and start
So
to.
we're LPs sort of invest in us because they want early access exposure, right? And if ever you invest in a company at 50 or 100 pre, it might be an awesome deal, but you're not supposed to invest in that company as an early access manager.
I think that LPs
Early
used
stage
to
manager.
care about 15 to 20% ownership until we convinced them that 10% was enough. And then they cared about 10% ownership until we convinced them that occasionally 5% is good enough. And now they seem to care about 5 to 10% ownership. And I think it's bullshit. I think that GPs move the number down to affect like where they need, and they need to sell the LPs on it. Why is 5 to 10% enough now when it used to be that 15 to 20% was required 10, 20 years ago? What has changed?
Well, I think
Because
back in
the portfolios back then were more concentrated.
Well, and there was nobody, I mean, when there were no angels, when there weren't any smaller funds, and you only had these traditional Series A funds where it was like, listen, you want money, I want 30% at this, with this term sheet, with these terms, and it's straight equity, take it or leave it, that's what you were working with. Then you had another skew of firms that came in and were like, you know what, we'll give you less money, we'll take less ownership. That might be more exciting because now you can grow into evaluation.
Remember,
and then
the-
you've got angels, so it wasn't the same landscape.
Remember those early stage deals that we saw back in 2002, 2003, where you had entrepreneurs having to accept a 5-on-5 or 4-on-4, right?
So you
those
think that
those days are
outcomes
gone,
become-
thank God.
Outcomes are bigger, therefore I can have 5 to 10%, it's still okay. But still ownership does matter, you're saying?
Yeah.
Okay.
And it's correlated to the amount of companies you can actually truly sort of support and help as a manager, and that's why we've been shrinking the size of our portfolio from 65 in Fund 2, 55 in Fund 3, and 45 in Fund 4.
Number of companies.
Number of companies, yeah.
Okay. How many board seats do you have, Jeff?
I have 6.
6? Okay. Hunter, I know you're still getting started, but
Yeah. I mean, we think we can each do about 10 at a given time. So
10?
Holy fuck.
I can do 10.
No
my
way.
partner can do 10.
No way.
From
10 early stage. I mean, you tell me how you
Oh,
do it.
well,
'cause I
so-
can't.
I just want to know what the numbers are.
We're
Yeah.
just starting,
Shadi's
and
just
so as
starting.
we're going to be writing bigger checks, we would like to take board seats, probably transition off on those later on, but I was thinking more around the 5 to 6 is manageable.
5 to 6.
10, I think, is challenging to just do that and
Okay.
nothing else.
You're going to invest in 25 companies out of the current fund. You have 3.5 partners. Math doesn't quite work there.
I don't know that we would necessarily take board sheets on everything. I mean,
Okay,
we're
fair enough.
going to be trying to lead some of these deals. We're going to be coming in later on some of these deals. I think it will vary.
Manu, board
My
seats?
target is to keep about 6 to 8 companies active, like so where I'm actively working with those companies.
Right.
And I think I currently have about 9 board seats.
Okay.
Yeah.
For
So
the record, I
I'm
don't think
over
board
one.
seats matter. I think
So-
board rights matter. I can provide value without having board seats. I'd love to have control if it's possible. I usually don't
Well,
have
the
enough
point of
ownership.
taking the board seat, perhaps, is to actually provide some value.
Bullshit. The point of taking the board seat is to have control and to
It
have
depends
information
who you're
rights.
talking
No, no,
to,
no,
and
no.
I think that's the fear for a
You're
lot of
totally
come
wrong,
on.
Dave.
Yeah.
You're
Disagree
totally
Not
with
at
you,
seed.
Dave.
If
What are
you
you gonna-
love
what are you
the
gonna do?
company, you don't need a board
What
seat
can you
to
do?
provide
What can you do
value.
with
You
control
can
it?
get value without
You're
taking a board
absolutely
seat.
right.
No.
You could.
You're wrong.
Do
But
your
you can also
LPs
provide
do your
value.
LPs require that you have board seats?
No.
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 Do they want general control of the company
No.
in some way?
They want
No.
us to do a
Should.
good job and get the companies
They
to
should.
succeed.
Yeah.
And in some cases, we feel that taking the board seat is the best way to
I'm-
do that. In others, it's not.
Obviously, I'm a terrible moderator. The panel is in outright mutiny against me.
So we all
how about-
agree,
how about-
except
wait,
you.
Follow-on checks?
Yes, Series A, Series Bs, we reserve roughly 60% of the fund, 65% of the fund for follow-ons.
Okay, so more than half.
Yeah, we're at a 2/3 reserve also.
We're around the 50% mark. We have a lot of internal conversation getting started right now, very much around follow-ons, Prorata Rights, special purpose vehicles, how we feel about that, cross-fund investing, which I don't think enough LPs pay attention to. They get really caught up on management fees and carry, and they're not really looking at some of the other dynamics that are happening between funds. So we're figuring it out as we go, but my general belief is a lot of the value creation is staying in private markets for longer. And yeah, we believe in following on. It's just a matter of how you do that and what vehicle it makes sense to do that from.
Manu, follow-ons and how far?
So I'll do, I've done stuff that's been seed. So seed is a follow-on for me.
Okay.
Seed, Series A.
Pre-seed, seed.
Yes. Seed, Series A, and Series B I've participated in.
Okay.
And I've done as much as 10% of the fund into a single company.
Wow. Lean in.
Yeah, so I'll go up to $4
Different
million.
kind of lean
a
in there,
company.
but.
Yeah.
How many of you have done special purpose vehicles to do beyond your reserves for follow-on? Haven't yet? Really? Lift? No? Huh. You guys tell me you're really awesome. If you're making 5 to 10% unicorns, aren't you leaving money on the table by not doing Series C and D investments in all those unicorns? Fred Wilson thinks
I screwed
so,
up big
right?
time by not doing the Series C of Fitbit, yes. That's true.
Likewise, I would say I should have done the Series B, the B, C, D of Lyft and Twilio both.
Right. I mean,
So,
shouldn't you
yeah.
build a predictive model for what
So-
percentage of your Series B companies get to C and D and reserve or at least estimate special purpose vehicles or a
Live and
growth
learn.
fund?
Live and learn.
Yes,
What-
you should, right.
Yes.
Yes, you should.
So we may at some point sort of address that, but what we sold was we do seed A, B. And
Okay.
by the time we sort of get to the B, the dilution, if you look at the compound dilution of the C and the D, it's not meaningless, but it's not that meaningful.
Right. I mean, I think you're reaching terminal ownership based on check size by
Yep.
your second check, if not certainly by your third.
Yep.
Or it's a really big third check, and you should just push that into a different vehicle.
But if you believe these companies are still going to be growing and they're not at their terminal value, and you actually have an ability to
Right.
put in more money, you actually have Prorata Rights and you can actually use them. Even if you don't do it, I mean, you've got to. I mean, for whom are you creating value? Yes, for your entrepreneurs, but ideally, hopefully, for your LPs.
What about
and there is
what-
some of your LP community that would probably likely
Wanna go
enjoy
direct.
doing that at a later stage with a larger
Maybe
piece
your
of deployed capital.
LPs would
And
diversify and buy out your position and take over your pro rata,
I
wouldn't
mean,
you?
What about selling into those rounds?
Yes.
We've talked about this. I mean, what was it? We were talking about if you're not buying, should you be selling? How long are
Absolutely.
you holding? I mean, I think there's a hold involved in there. You guys, I don't think do.
When do you guys expect money to come back, if ever?
On average, it's been 8 years, I think, 7 to 8 years. Like for the
We made money on Mint in 2 years, Jeff.
yeah, but when so what is the question? When do you make money on an individual deal, or when do you actually return the fund? So DPI.
Oh, I see what you're saying,
DPI
right.
equal 100%.
Got it, you're correct,
The
you're
answer is 7 to 8 years.
Okay, and you're saying you get to 1x or you start returning capital?
So 100% DPI means you return the entire
Yes.
fund.
You're just saying you'll be able to return 100%, 1x in 7 or 8 years.
Yep.
Damn fine job.
Because the point is, we actually reserve. I mean, we redeploy the half of the proceeds so that we can actually get to 120% of the fund invested. So we do pretty heavy recycling, and therefore, if you look at Fund 2, half of it, which would have returned the fund if we hadn't sort of
Got it.
recycled half the capital.
If you had money sitting around, would you choose to recycle it or choose to deploy it back to LPs? Do you deploy 80%, 100%, or more than 100% of your capital?
120%.
You actually do
so
deploy
we
120%.
so we turn the cash twice, almost. I mean, we turn half the cash twice.
Yeah.
So if you think about, so here's the
we
math.
did 120% out of Fund 1. I don't find most people are able to do that.
So if you think about the fund, 75% of the fund is invested, 25%
Right.
is the fees and expenses.
I got it.
So you have to turn, those expenses back into the fund, and we take another 20% and reinvest it.
Got it. Do you guys recycle capital?
Yeah, we're going to do minimally 100%.
Okay. Target 100%. So basically take 20% of take your first 20% of proceeds to redeploy.
Fund
guys-
2 is at 108%, for example.
Depends on your fees, yes.
We're not there yet. We've got a provision in there if we want to. We'll figure
Good.
it out when we're further along.
Okay.
Haven't done it yet, but thinking about it.
Okay. And Manu and Jeff, are you guys at carry yet? You written yourself a carry check yet?
Nope.
No.
Any ideas on when?
Well, it's a
I
lot
wanna
of
know
the
when I can come to the
a lot of the
party.
high-valued companies they're on paper, right? So that's
Yep.
what we talked about earlier. So,
Okay.
so you have to wait
And-
until you actually realize.
And
those,
would
so-
you sell into a later stage round for lift that you might be able to get to carry earlier, just to get to carry?
Not just to get to carry, hell no.
Okay. Hell no,
Mm.
for diversification purposes?
I believe in what they're doing. I wouldn't sell right
How
now.
about you're in a position in a company right now where you're up over 50x, or at least let's say up over 20x, and you think the market is a little frothy right now. Do you sell into the round? Do you do some liquidation? You've already hit a target return that's interesting.
20x, no, 50x, potentially considering.
Yeah. Sell into a round once you've hit a 50x target ownership. Sell 20% or more?
Depends on what's, so two questions. One is, what is available to us? Because, it's not because you want to sell that you can actually find someone who's going to buy, and the company has to approve the whole transaction.
Right.
And if we feel that it's a good diversification of the fund's risk to do so.
Any of you guys invest in other funds or fund managers?
Nope.
As in, like, at our stage?
Do you help other people get started?
Still
No,
trying to
so-
help
Sorry, I'm
myself
raising
get
a fund. I'm
started.
about to hit you up.
I mean, I'm an LP in other funds, and I like to try to help people get their funds raised, but Homebrew doesn't
Hunter
invest in other
you wrote
funds.
us a check.
I'm very happy to have done so.
Okay. Anything I haven't covered? I know we had a lot of
So
material.
I want to make one comment because
Yes.
you touched on Prorata. And the comment I wanted to make there is that Prorata should not be it's a right, but it's really a right that needs to be earned.
I agree.
I believe
and-
Travis is on record saying that nobody should get pro-rata rights ever.
And it should really be like, if you've genuinely helped the company, then the founders should say thank you by allowing you to actually participate.
And on
in
that
the
basis,
next round.
why
So-
pro-rata? Why not
so-
super pro-rata? Why not an explicit
Absolutely,
aggregate
yeah,
amount?
super prorata too.
Right.
I've done super prorata in
Yeah.
companies.
Well, in practice, when you want sort of a piece of the company at a later stage, the founder will have to go to bat and defend you, for the new investors to actually let you take that. So it's what's happened.
Last question before we get out of here. They're giving me the hook here. Platforms, brand, value add. What's important? What do you think about? Doesn't matter?
Brand and value add. Platforms is if you can afford it.
Is that just your board seat or is that something else?
It's a bunch of events. It's getting the work. Getting the portfolio companies sort of together. It's a bunch of different things that you do for your companies, and then founders sort of talk to other founders about how useful you've been.
We had 3 goals for our first 2 years, which were 2013, 2014.
Blogging every day.
I failed on that. Get our operations up and running, close the brand awareness gap between ourselves and our friends' funds that have been out there a few cycles longer, and deliver against the commitment we made to our founders. And I think that third is the most important of the 3.
I think value add is the most important. If you're going to provide value add by differentiating yourself, great. For us, we actually think resembling the users and the customers for which these companies are building perhaps is somewhat relevant, and can perhaps provide a interesting perspective around the table. As far as building a brand, yeah, I mean, I think it's great on the marketing front. We haven't gotten to that yet, partially because we haven't even been allowed to do a lot of that stuff yet. But yeah, I think that's valuable. But at the end of the day, I think it's about what value you can provide to these founders and to your LPs.
I'll summarize it as I'm all about quality over quantity. And as I said, time is the most valuable thing to me. And so I want to make sure that when founders are actually coming and looking at K9, they are self-selecting as to whether or not they should even be talking to us.
I have a million other questions I'd love to ask you, but thank you guys for enduring the firing line. And good luck on those very concentrated portfolios. I hope you're great at picking unicorns.